Hi everyone, this is Murugan from EQSIS. In this video, let me explain max pain theory. This concept is widely used to forecast the expiry prices. Max pain theory can help us to understand the probable direction, support and resistance. Sometimes it hints us to anticipate a short covering rally as well. So at EQSIS, we have tweaked the original max pain calculation process. So in this video, let me tell you why we did that and what more information we can find out of that. And I also tell you the calculation way so that you find a logic out of that. So in this video, we're going to cover these aspects, that what is max pain, you get to know, and how it helps an option trader to strategize the trade. And of course, we can also share you certain max pain charts and tools that saves a tons of time and you can actually focus to strategize your trades on ongoing basis. But to understand this video, we expect some prerequisites from the viewers. So if you are someone who's very new to option trading, if you don't even know what is call option, what is put option, what is open interest, what is trading volume, better you actually brush up your basics by looking at some beginners module videos and you come back here to, even I can recommend that you should have some solid understanding on option chain analysis. For that, you can refer our channel. I think the most recent video I posted is on option chain analysis. Then you come here so that you understand a lot more understandings. Let's quickly get into max pain. What is max pain? I think it is a maximum pain to a trader. Okay. So as an option trader, we don't just place our bet on direction. Our return is also dependent on time decay, volatilities, and a lot more factors. In general, the time decay is something which against the option buyer and quite favorable to the option writer. But it does not mean option writer always makes money. Option writer do feel the pain when the market takes the direction against his expectation. Hence, on the expiration day, either the option buyer or the option seller is going to feel the pain. I hope by this time you got me, that I mean the pain is nothing but the unfavorable scenario which causes loss to the trader. So of course, on the expiry day, sometime a buyer loses money, sometime a seller loses money. But a general notion is that the buyers mostly loses their money and whatever premium paid goes waste. Am I right? So the max pain concept helps us to calculate the spot price on the expiration day where it causes the maximum pain to the option buyer. So note this point, I'll tell you why this original author talking about the option buyer. But before that, I will also be narrating what happens to the maximum pain to the buyer, maximum pain to the sellers, and a lot more concept. So I hope you guys can see there is a 3 instruments I've taken for a better understanding. The very first one is actually the future. So if you look at the future buyer, let's say I take a long position at 10,000. Remember one thing, when a market goes up, I just make money. So all are make gains. I have no problems. I don't feel a pain. But if a market goes down, that is going to trouble me. So this is where I actually feel the pain. But remember one thing, when a market goes down, the future buyer will have unlimited pain at the downside. By this time, all I want to convey is one word, that is unlimited pain. Whereas look at this particular one as a call option buyer, when you buy 10,000 strike, by paying 100 rupees. So now when a market is at 10,000, even if it makes some progress, you will not be making money. The market has to cross at 10,100, which is called as your break-even point. So anything above 10,100, an option buyer is going to feel the gain. But if it fail to do so, by any chance, if the market starts going down or if it stays in between, option buyer feels the pain. I'm using the word feels the pain. I mean, the 10,100 is actually a very notable area for a buyer as well as seller. So 10,100 is where a buyer, neither a seller loses money. But beyond 10,100, a buyer going to make money, but a seller is going to still have unlimited pain, whereas anything below 10,100, buyer is going to have a limited pain of 100 rupees. Murugan, why are you using the word pain here? Why not we can use the word losses as we use in general videos? No, this is a video which talks about the maximum pain. I just want you to understand this term so that when I talk about this concept, it becomes much easier to convey the concept. So let's actually take the put option perspective. As a put option, it is true again, when I actually trade with 10,000 put option, when the price actually goes down by 100 rupees, it actually breaks even, and below which it actually makes me comfortable. If it failed to do so, I will be risking myself of 100 rupees. That's the pain to me as an option buyer. So we have seen everything from the option buyer, but you might have heard of this one: option buyer pays premium and option seller receives the premium, and that premium is all ball game here. Look at the next one so that I can make you to understand the concept in detail. Look at this time, what I did is I didn't actually buy just one contract, I've taken both the contracts. So now what I did is I've taken a 10,000 call option, okay, and 10,000 put option. And by the way, both comes to me at the price of 100 rupees as a premium. So I hope you must be very clear about this, that the total premium paid by me is only just 200 rupees. But remember, for me to make money, the market either have to cross 10,200 on the upside or 9,800 at the downside. I think if a market managed to go beyond this point, only then a buyer can actually make money. I think 10,200 and 9,800 is very well going to act as a break-even point. I mean, if a market expires exactly 10,200, I'm using the word, if a market, if on the expiration day, if a market settles at 10,200 or 9,800, neither a call buyer or a call seller or a put buyer or a put seller, I think put together as a strategy trader, will not be making money. So it is a no pain point to the traders. I hope you understand this concept. By any chance, if you didn't get the point clear, better you rewind it for a minute and then see this video again. I hope you get the point. But if you understand what do I mean by no pain point, let's proceed further. So as of the buyer maximum pain will be at 10,000. I hope not much of explanation is needed, because if a market settles at 10,000, as a call buyer, as a put buyer, I end up losing my both 100 and 100. Maximum I lose is 200. So remember one thing, this 200 is a maximum loss that can happen to me. That is what I call as a max pain. So I hope you understand what do I mean by this. Okay. So the max pain is actually only 200, which can happen if the market settles at what level? 10,000. So remember, we are trying to identify this point, but we have a lot more calculations so that you understand it quickly, but I'll make it as simple as possible with a lot more examples. But remember one thing, seller do have a max pain. Okay, but his max pain is not a max pain, it is the unlimited pain. Sellers can feel the unlimited pain if a market makes a volatile move. So that is the reason why a buyer loves a non-volatile days. Sorry, the seller loves the non-volatile days and buyer wants the volatile behavior. So I think that's a simple math that anyone can easily understand. Let's quickly move forward. Now I'm not going to take one leg or two leg. Now I'm actually going to take a scenario of taking 3 call options and 3 put options. Let's assume we just got, forget about this payoff. Now I want you people to stick to this one. Let's say we have a 3 option. One is 10,000 call, 10,100 call, 10,200 call, and a put again 10,000, 10,100 and 10,200. So I've just taken some premium, which is 10,000 trading at 100 and 70 and 50 respectively, and of course the put again 50, 70 and 100. Okay, let's assume the market is around 10,100. Sometime you might have heard of this, why not I buy all the call options and put options? Wherever market goes, I make money. I think that may be a very beginner who think about the options. And then as you used to it, then you think, like the option sellers were actually making a lot of money because most of the premium goes back to 0 level. Why not let me sell all call and put? So wherever market goes, I end up taking a lot of premium end of the day. No, either by buying all call or either by buying all put, there is no guarantee that you end up making money by month end, but that will actually tell you at one level you end up making the maximum loss or the maximum profit. So let me share a bit of concept here. Okay, now let's say we have taken 10,000 call, 10,100 call, 10,200 call, and 10,000 put, 10,100 put and 10,200 put. So let's say if a market exactly settles at 10,100, just remember, if a market exactly settles at 10,100, what happens to 10,000 call? This gets the intrinsic value of 100 rupees. But remember one thing, the premium paid is 100 rupees. So net is 0. Whereas 10,100 If a market settles at 10,100, you get nothing. So the intrinsic value end up 0, but the premium paid 70, so that become minus 70. So I hope I don't have to explain all these things. Hope you guys can easily understand that the 10,200 still becomes 0 and your premium is a net loss. Whereas the put option, if a market expires at 10,100, becomes out of the money and you still lose 50, and 10,100 is at the money, still you make nothing out of it, so 70 is gone. Whereas 10,200 gets you 100 rupees, but the premium paid is 100. So what happens end of the day? You end up losing 240 from your packet. If a market settles at what level? 10,100. Let's try to understand, by any chance, if a market settles at 10,200, if a market settles at 10,200, and by the way, this is now in the money by 200 rupees, but again the premium paid is 100. So what we get is 100 rupees as the net value. So think about it. As an option trader, I got 6 legs. Remember, I got how many legs? 6 legs. But the 6 legs collectively gives me minus 140 if a market settles at 10,200. But by any chance, if a market settles at 10,100, oh my god, I may lose even 240 rupees. And sometimes we may think, Murugan, by any chance, if a market settles at 10,000, what happens? Your call would have not given you money, whereas the put would have given you money. So again, even if a market settles at 10,000, I hope this is not a rocket science. So you as an option trader, I assume that you guys can easily figure out this. Okay. So then if you sum both the call and put by taking all 6 legs, you still end up losing 140. Now you may ask a question, Murugan, what happens if a market goes to 9,900? Remember, if a market goes to 9,900, all call premium paid by you is actually out of you. So the premium paid by you is close to 220 rupees is gone out of you, whereas in the put options, 10,000 actually becomes in the money. So try to understand, it becomes in the money, so you still make, it should be ideally green color, okay? It should be plus 50, and this 10,100 makes 130 rupees, 10,200 makes 200 rupees. Murugan, it should make 300, no, 300 minus 100. So I'm talking about the net payoff here. So with that, it becomes 160. So what am I doing it? I'm trying to calculate my payoff wherever the market happens, whereas I have taken all calls and puts which are available in the market. Then if a market goes to 10,300, remember, all put options on this side becomes out of the money and you loses all your premium, whereas the call options, in fact all the call options becomes in the money. Even 10,200 gives you 50 rupees as a net returns, and 10,100 gives you 130 and 200. Still you end up getting 160, but it should be plus. I hope you got me, which is 160, which is a plus, I hope. Am I right? So now try to understand, when market settles at 10,100, you're losing 240. But if a market somehow settles at 140 or 10,200, you are going to not lose much. I'm talking everything from the option buyer perspective. So if I ask you a question, at what level that option buyer is going to lose a lot, that you have to figure out. If you figure out that particular thing, that particular point becomes the max pain. So when it comes to, we have you can take option chain and you can take all the strike prices, and with that you can do this particular one, so that you get to know at what level that the option buyer is going to lose a lot of money. But if you blindly do it, remember one thing, at the money is the one which generally causes the maximum pain. But by adding the weightage of open interest and trading volume, this can actually change a lot. Let me come back to that bit later. So now let me go to 9,800. What happens? Option buyer can make a lot of money through a put options, but whereas the call option is going to lose this limited loss of that same 120. So that is what the option buyer really wanted. He wants a big move. It doesn't matter, it goes in my favor. Big move really wanted by the option buyer, whereas the option seller does not like that. Okay, and even if it is 10,400, doesn't matter, I end up getting the same thing. So as long as market makes a big move, option buyer makes money. I have a reason to convey this often so that I can connect all the dots as I move forward. So if a market goes to 9,700, you end up getting 760. I hope you guys can make a guess about 10,500, which will be again 760. So it's not a rocket science. Now pay attention here. What am I trying to convey here? See, now I'm going to plot this into a chart. So try to understand now, when I plot this, you can see that it actually forms something like this. Now I hope it is simple bar chart, I mean denoting these numbers. So by doing this, you got a point that 10,100 is a level which causes the maximum pain to the option buyer. This level is called as max pain. Try to understand this level. So what you people have to do is take the strike price and take all the premiums and take all the call premiums and try to calculate it. Of course you end up getting this at the money, but if you give a weightage of all the open interest, so then it will be skews towards the towards this side or that side. So at any point of time you can figure out that where is the maximum pain point and where the market is. Then Murugan, why this concept, in what way it will be useful? See, the max pain point as per the original author, it is expected to expire at that level because that is the level which makes the seller so comfortable. But he made a wild assumption that seller is someone who is this strong hand in the market. I also agree that the sellers are quite strong in the market, but remember one thing, it is not the seller is strong. In fact, market and external environments are much more stronger than the market participants. So it means sometime when a market makes the exotic behavior, sellers do unwind their positions that trigger the short covering rally. So we need to know what is the current level about the max pain and what is the expected max pain. That will tell you whether the market is going towards that or is it going to witness the short covering rally. But before I proceed further, let me actually explain that using an actual example. Let's take this concept using the browser. Okay, so let me quickly open the browser here. Okay, now I'm actually taking the I just request you people to go to a website which is EQSIS.com. Okay, when you actually get into this EQSIS website, you have an analysis section where you can actually find something called option chain this NSE max pain option, a max pain analysis. And by the way, just for our existing followers and those subscribers, as we said last time, we have a plans to upgrade our option chain filter. I think option chain filter last time, a lot of you people have contacted us, a lot of you people are finding it very useful. I hope you people continue to do it, and we have made some changes and we have updated that. And most likely we will be posting. I hope you guys can see the EQSIS support remarks, like firm support fading away, weaker support, and you have the firm resistance fading away, weaker resistance, and you also get something called notable support and notable resistance. So we will be covering up this area in upcoming videos. So and we also have a support shifted lower or resistance shifted lower. So this is something which talks about the option chain analysis. Okay, but as far as this video is concerned, what you people have to focus is NSE max pain analysis. NSE max pain analysis. Get into this particular section. Okay. Now, what actually it tells you? So sometime back, I was talking about it. Let me take a company called Bank Nifty. So if I take a Bank Nifty for I'm talking about this 30th July. I'm recording this on 28th July around 6:30, 7 o'clock. Whereas now I think it's post expiry. I hope you guys can see this particular area. So now try to understand. Let me actually keep only this call options alone. Let's take this call options alone. I hope you know that when a market actually makes a progress towards 22,000, 23,000, 24,000, 25,000, 26,000, the call option buyer starts making money. So when a market goes all the way up, call option buyer make money. If market goes down, the call option buyer makes nothing. In fact, he loses whatever the premium paid by him. Am I right? Whereas the put options, look at the put options. Put options buyer will actually make money when the prices starts heading lower. Okay, but remember one thing, if you have a call as well as put, what happens if a market either goes down or goes up? Being a person who hold both call and put, you will be happy, but you feel uncomfortable if a market remains at the same level. That is the reason why if a market kills time, you don't like it, and if a market loses volatility, you don't like it. But in general, that both in favor of the option seller. That one should understand it. Now if I have both, so you have a call and put, and this, the lowest intersection point is what we call as a maximum pain point to the option buyer, whereas the option seller is actually going to incur a very less loss if a market expires at this particular level. But Murugan, you said sometime back the original calculation process is different than this particular one. How come it is actually different? See, if you look at the original max pain calculation, they hardly concern about the premium paid. But remember one thing, if you use the word pain, let's say I am an option buyer, paid 10 rupees, and if I don't execute this contract, if I don't exercise the contract, I lose the 10 rupees. That is a pain to me. Even if a market recovers by even if a market settles in the money by 5 rupees, still I feel the pain of 5 rupees because the premium paid by me is actually 10 rupees. So that is how the traditional max pain concept is being tweaked by us in terms of the negative value. So in any of the max pain concept, anywhere you go and you end up seeing only the positive values. But at EQSIS, what we do is you can actually see something called the buyer max pain and seller max pain. So what do I mean by buyer max pain? If it is a buyer max pain, you can actually see that the curve goes even below zero. It means a lot of premiums being paid by the buyers at early days, but the markets were not made much move, and the max pain point stays at this level. So now as far as the Auro Pharma is concerned, so remember Auro Pharma price is now 810, but the max pain point seats at 800. So Auro Pharma is expected to expire around 800. This is what this particular table tells you. Very simple. So if you are someone who's slightly new to it, what really matters to you is where the market is really heading to. So we assume that max pain is what the level which works as a magnet. So remember, if a market is being slightly away from that, it tends to attract. But if a price comes towards the max pain level, then it works as a support or resistance. So try to understand this. When it comes to Axis Bank, if you click on Axis Bank, still you see negative. Why it is negative? Because the premium paid by the option buyers were not even recoverable if a price settles at that particular level. So that is what sometime back we have seen. Now this is the level where it can be negative. So that is how slightly it is different, Murugan, because now you understand something called a tangent point to the zero. I think the break even. So within this range, okay, if a market settles towards that particular the range, that range is going to work as a support and resistance, because that range is going to act as no problem to the seller and no problem to the buyer. So that is how this can also be talked about the range. But if I don't want to cover so detail of that because it goes beyond the scope of this video. But anyway, coming back in a quick note, so I hope you guys got some clarity in terms of how to use this particular tool. So we have symbol wise filter. So we have almost all future contracts and all derivative contracts are available here, and they're trading above max pain and trading below max pain. So if I click on here, so you get to know the companies which are so above the max pain. Look at this one, the Adani port. The max pain point is 327. The max pain point is 327, but the future price is around 310. So I think, by the way, this is a stock which is expected to go up. So that's why we used a point which is have to be corrected. 310, which is expected to go up. Look at this Bandhan Bank, max pain point is at 354, but it is at 341. But look at this BHEL 36, it is expected to go towards this 38. So I think what you people see at the last column, which is the fourth column, is a percentage difference. So from this level, you have a 5% move is quite expected. But remember one thing, if it is a larger difference, then it can actually create a kind of short covering. In fact, if you know this week, what happens is, look at the Nifty. Okay, if you look at the Nifty here, the Nifty max pain is sitting somewhere around 11,000 mark. Okay, Nifty, I think a lot of people were talking about this time like 11,100. These guys have not subtracted the premium. So that is why our max pain is actually quite different, because we give importance to trading volume. We give importance to, we also give importance to the premium paid at so many days. So because the premium paid by the option buyer is what actually going to create a pain. It is not only where it settles at the expiry days. So now look at this one. As far as the bank nifty is concerned, like 22,500 is actually going to act as a the max pain point for the the traders. So I think this was settled it as of 24th July, but we quickly update as after the data is everything available to us, so that I think when I upload the video you can actually see the latest the data as well. So I hope you guys get some clarity in terms of what do we mean by this option chain the max pain analysis till this particular level. And if I take one step forward, you guys can also use this particular one, which, and by the way, if you want to figure out the charts, what you can actually do is you guys can actually click out check on the any of the company names. You can actually check on the company name, you actually get to know the max pain point. I think the brown color point which is being highlighted here is the max pain point. Okay, now what are all the things that one should actually understand? Look at this. Always try to understand where the stock is. So if I take this example again, okay, let's take this case. This is how the max pain chart is, okay, and if the stock is actually trading here, it is expected to come over to this particular area. So we can expect the price to slightly go back. If the price is here and the max pain point is here, we expect the price to go slightly on the higher ground. But Murugan, you said sometime back a short covering rally. What does it mean? Okay, look at the case of this company, and let's say the max pain point stays at 197. The max pain point stays at 197. By any chance, if a market goes to 200, 203, 204, 208, 209, and 210, remember one thing. Seller will not feel much of the pain, because still they have a no pain point, because it is still comes to zero level. But if a price goes beyond this level, I think they will be in loss. Remember, buyer has a limited loss of the premium, so they don't have to panic, whereas the option sellers do panic. This is how we understand the short covering. So when the price actually takes a wild move from the max pain point, and by that point, if the max pain troubling them a loss to the seller, I'm not talking about the buyer, loss to the seller, I mean from this chart perspective it should be above zero, then that I'm talking about the black curve. I'm not talking about the red or blue, I'm talking about the black curve. Okay, this particular one I'm talking about it. Then it can actually trigger the short covering rally. I hope you find some sense out of this particular video. And of course, as I said some time back, what you people can actually do is just go to our YouTube channel, okay, and if you go to YouTube and type EQSIS, I hope you will also get it. Like if you go to EQSIS, okay, you will also find our YouTube channel here, okay. And of course, this is what we said, the latest video, and we have a wonderful video with respect to market depth, and of course the most recent video we posted, which is option chain filter, okay, and there we have explained how to find the support, resistance, and lot more things using which. So I'm sure you will also like that particular one. But if you really like this video, okay, you can also contribute in various ways. Okay, we are not taking any donations, but I hope you guys can share our video, which can actually take it's a non-monetary support that one can actually do towards it, and that will help us to reach a lot more people, and it actually motivate a lot, so that we can actually come up with a lot more interesting videos which which can probably save the time. And of course, as a bonus, whatever the charts and this I've shown to you people, which is absolutely free, so make use of it with all due disclaimers that you take decisions on your own. But I hope you guys can see that it is a future price and the max pain price, so that, and there is a percentage difference, and of course you have a the seller in maximum pain, and there are a lot more filters are also available. Hope to see you soon in the upcoming videos. So by this time, you will not forget to share this video, and of course do like this video. And there is a strong complaint from some of the existing viewers that, Murugan, I'm not getting your videos these days. Murugan, what happened? See, we are not a very frequent video poster. We post one video in a month or one video in 2 months. So we are not very often. So don't hesitate to hit the bell button, because we are not someone who's gonna keep disturbing you. So hit your bell button. So make sure that you enable your notifications, and then I'm talking about this bell button. So after subscribe, so make sure that you hit your bell button so that you will definitely get notifications by the Google. If you simply subscribe, you may not get it. So as per the YouTube concept, you have to hit the bell button. Hope you find this video interesting. And of course, if you want to check out our training sessions, do check out our online training session for the option traders. We have it in the online training, which is happening at this Sunday. Otherwise, mostly once in a month we will be having a session as well. So don't miss out this. Thanks for joining us.